I just received my first paycheck of rupees 10,000. My grandpa always told me to invest my money first and then spend it. Let me buy a few stocks. How will I know which stocks to buy?
Hi Neha,
Who are you?
I'm your friend Mr. Ratios. Let me introduce myself. In the world of accounting and finance, I am the relationship between two numbers indicating how many times the first number contains the second.
But how will you help me choose the best investments?
There are many ways to do that. Let's say there are two fruit baskets. The first basket contains 10 fruits, but 2 are spoiled. And the second one contains 12 fruits, but 3 are spoiled. If you had to select the one in terms of quality of fruits, what would you do?
Very simple. I will divide the total number of fruits by the number of spoiled fruits.
Correct. That is what I do. So for the first basket, you have the ratio of 10:2, which is 5:1. This says that in every 5 fruits, there is 1 spoiled fruit. And for the second, it is 12:3, that is 4:1. This means in every 4 fruits, 1 is the spoiled one. Now you can say the first basket is the better pick.
But how can you help me in taking a financial decision?
When you are analyzing a company, you will look at key financial items like profit, expense, revenue, etc. But you cannot compare pure numbers. But I compare two aspects of financial statement by establishing a measure of relationship between the two variables, thus making interpretation easier. For example, the relationship of profit to sales, or say asset to sales. Thus, you can use me to evaluate the financial condition of a company, how well a business is performing, and its strengths and weaknesses. In short, I provide a clear understanding about the company's profitability, liquidity, solvency, and operational efficiency of business entity.
Interesting. Now I'm all set to make a well-informed decision with your help. Thanks, Mr. Ratios.
Hello, so let's talk about introduction to ratios. A sustainable business and mission requires effective planning and financial management. Ratios allow us to compare companies across industries, big and small, to identify their strengths and weaknesses. Ratio analysis is a useful management tool that will improve your understanding of financial results and trends over time and provide key indicators of organizational performance. Internal managers will use ratio analysis to pinpoint strengths and weaknesses from which strategies and initiatives can be formed. Funders may use ratio analysis to measure your results against other organizations or make judgments concerning management effectiveness and mission impact. Ratios sound complicated, but they really are not. Let's begin the learning process. The objective of this tutorial is to explain financial ratios, their uses and advantages. In this session, we will also learn about the uses and types of financial statements and financial items. We will also take a look at the different types of ratios and finally understand few cautionary points while using ratios for performing financial analysis. Now that you have a brief about ratios, let's begin with what are financial statements. Financial statements report a firm's position at a point in time. It helps in assessing the firm's past, present, and future financial condition. Investors use financial statements to predict future earnings or dividends. Financial statements also helps to analyze a company's financial strength, weakness, and in general the financial health of the company. Management uses financial statements to help anticipate future conditions and act as a starting point for planning actions that will affect future events. There are 4 financial statements which gives us a holistic picture about the financial health of the company. They are balance sheet, statement of retained earnings, income statement, and the cash flow statement. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholders' equity at a specific point in time. Whereas the statement of retained earnings reports how profits are divided between dividends for shareholders and retained earnings, which are kept on the balance sheet to accumulate under owner's equity. An income statement, on the other hand, is a financial statement that reports a company's financial performance over a specific accounting period. also called as the profit and loss statement or the P&L statement. It is a report that shows the income, expenses and resulting profit or losses of a company during a specific time period. And finally, the cash flow statement. Cash flow depicts the amount of cash generated during the period which is not reflected in the balance sheet. It tells the total amount of money being transferred in and out of a business, especially as affecting liquidity. Now, categories in cash flow statement includes cash flow from operating activities, cash flow from investing activities and cash flow from financing activities. When it comes to investing, analyzing financial statement information is one of the most critical element. However, the humongous size of data can be a bit confusing and investors may get bewildered with this massive amounts of information. However, with proper and systematic financial ratio analysis, one can interpret these numbers in an easy to understand and organized way. So what is ratio analysis? In its simplest term, ratio analysis is a form of financial statement analysis that is used to obtain a quick indication of a firm's financial performance in several key performance areas. Next, let's talk about why use ratio analysis. For example, rupees 100 profit on sales of rupees 200 is quite impressive, but rupees 100 profit on sales of rupees 10,000 is not. Absolute numbers are not good enough to understand financial metrics. Hence, investors look at ratios to make sense of these numbers. Ratios explain the numerical relationship of a financial variable with another variable with which it has a theoretical relationship. These relationships between the financial statements help investors, creditors and internal company management understand how well a business is performing and areas which demands improvement. Further, they facilitate the comparison of firms which differ in size. Ratios allows us to compare companies across industries, big and small, to identify their strengths and weaknesses. Ratio analysis enables readers to analyze the performance of a company, assess the financial stability and help in decision making. In addition, ratios can be used in the form of trend analysis to identify areas where performance has improved or deteriorated over time. Finally, ratios are easy to comprehend and simple to compute. Next, let's look at the objectives of ratio analysis. Firstly, ratio aims to standardize financial information for comparisons. They help to evaluate current operations and their efficiency. Ratio analysis also enables comparison of present performance with the past performance against other firms or against industry standards. Lastly, they help us to understand the risks of the operations which can be mitigated by the management of the company. Next, let's talk about who uses financial ratios. Ratios are used by managers, which helps them to analyze, control and improve a firm's operations. Credit analysts, and ratios helps them in determining a company's ability to pay its debt and interest expenses. Lastly, stock analysts determine a company's efficiency, risk and growth potential after looking at various ratios of the company. Next, let's continue talking about different types of ratios. Profitability ratios shows a company's ability to generate profits from its operations. They are a class of financial metrics that are used to assess a business's ability to generate earnings compared to its expenses and other relevant costs incurred during the specific period of time. On the other hand, activity ratios measure a firm's ability to convert different accounts within its balance sheet such as inventory, receivables, payables, etc. into cash or sales. The third ratio or the third class of ratio is liquidity ratios. They attempt to measure a company's ability to pay off its short-term obligations. This is done by comparing a company's most liquid assets, or those can be easily converted into cash, and try to see its ability to pay short-term liabilities. And finally, we have solvency ratios. Solvency ratios measures a company's ability to meet its debt and other obligations. Solvency ratios help us in understanding the funding structure of the company and to see if company has enough capital to take care of its long-term obligations. Next, before we take a deep dive into each and every type of ratio, let us understand the different limitations. There are a number of cautionary points that you need to be mindful of. The dates and duration of financial statements being compared should be the same. Effects of seasonality may cause erroneous conclusions to be drawn. Understanding seasonal factors that affects a business can reduce the chance of misinterpretation. For example, a retailer's inventory may be very high in summer in preparation for back-to-back school season. As a result, the company's accounts payables will be very high and its ROA would be low. Many large firms operate different divisions in different industries. For these companies, it's difficult to find a meaningful set of industry average ratios. And also, the accounts to be compared should have been prepared on the same basis. Different treatment of stocks or depreciation or asset valuation will distort the results and comparisons. In order to judge the overall performance of a firm, a group of ratios should be used. Also, to accurately identify the trends, at least 3 years of ratios are normally required. Because ratio analysis is based on accounting information, its effectiveness is limited by the distortions which arise in financial statements due to such things as historical cost accounting and inflation. It is difficult to generalize about whether a ratio is good or not. A high cash ratio in a historically classified growth company may be interpreted as a good sign, but could also be seen as a sign that the company is no longer a growth company and should command lower valuations. A company may have some good and some bad ratios, making it difficult to tell if it's a good or a weak company. Finally, financial ratios are not very useful on a standalone basis. They must be benchmarked against something in order to bring them into a perspective. Due to limitations, ratio analysis should be used as a first step in financial analysis to obtain a quick indication of a firm's performance and to identify areas which needs investigations further. In general, ratio analysis conducted in a mechanical manner can be quite dangerous. On the other hand, if used intelligently, ratio analysis can provide quite insightful information.